This video is for educational and informational purposes only. Nothing you hear today should be considered financial, investment, or trading advice. I'm not telling you what to buy, sell, or hold. This content is meant to help you understand market behavior and economic signals. And here's why that matters. By the time financial risks become obvious on the news, the real damage has already happened quietly in the background. The most dangerous moments in financial history don't arrive with panic. They arrive when everything feels calm, stable, and under control. And that brings us to silver, because if silver prices were exploding higher right now, governments would already be talking about it. There would be explanations, emergency meetings, and headlines. But silver isn't doing that. It's quiet, it's steady, almost boring. And that calm is exactly what makes policymakers nervous. Because silence in silver doesn't mean safety. It often means pressure is building where most people aren't looking. What if I told you governments are far more afraid of a calm silver market than a rising one? What if stability is actually the warning sign? Stay with me, because once you understand why calm silver prices are so dangerous to the system, you'll never look at the market the same way again. If you care about understanding silver, gold, and the deeper signals inside the financial system without hype or fear, take a second to like this video and subscribe. Here on Sayfee Metals Health, we focus on education, market structure, and long-term awareness for people who want clarity, not noise. Most people assume governments panic when silver prices rise fast, and that makes sense on the surface. Rising prices attract attention. They raise questions. They can even spark public concern. But from a policy standpoint, rising prices are manageable. They're loud, they're visible, and most importantly, they're temporary. Officials can blame speculation, adjust rules, or simply wait for momentum to cool off. Calm silver markets are different. Calm gives no warning. Calm allows problems to grow quietly. Calm lets physical supply drain without triggering alarms. And that's exactly what governments fear. Silver is not just another commodity. It sits at the intersection of money and industry. It's essential for solar panels, electronics, medical technology, defense systems, and energy infrastructure. At the same time, it has thousands of years of history as a monetary metal. When silver prices stay calm while industrial demand grows and inventories slowly shrink, it creates a dangerous disconnect between price and reality. A rising silver price forces action. A calm price hides inaction. When silver stays stable, manufacturers keep consuming at full speed. Governments are happy because production continues uninterrupted. There's no urgency to conserve, no reason to rethink supply chains, no public debate. But beneath that calm surface, inventories quietly tighten. Delivery timelines stretch. Physical premiums rise quietly, often unnoticed by the public. And once physical availability tightens too far, there is no emergency reset button. Another reason governments fear calm silver markets is messaging. Silver is deeply tied to inflation signals. It reflects energy costs, labor, mining constraints, and industrial demand. When silver prices stay flat during inflationary periods, it supports the narrative that inflation is under control. It creates the illusion of stability. But when reality finally forces a repricing, it doesn't happen slowly. It happens suddenly. And sudden repricing destroys trust. Trust is the foundation of every financial system. Trust in currencies, trust in debt markets, trust that prices reflect reality. Calm silver prices during stress periods quietly weaken that trust because they suggest prices are being managed rather than discovered. History shows us something important. The most damaging financial breaks don't happen during chaos. They happen after long periods of calm. Calm leads to complacency. Complacency leads to leverage. Leverage creates fragility, and fragility breaks without warning. Silver often acts as the early pressure gauge for that fragility. When silver is calm for too long, large institutions can position quietly. There's no urgency, no public scrutiny. Everything feels normal. But once the system reaches its limit, liquidity vanishes instantly. Markets freeze, and officials are forced to respond without preparation. Governments prefer visible stress because it can be explained and managed. Hidden stress cannot. Calm silver prices also keep the public disengaged. When nothing moves, people stop paying attention. And that's when structural problems grow unchecked. When silver finally reacts, it doesn't creep higher. It jumps, it gaps. And those gaps expose how disconnected price had become from physical reality. This is why silver doesn't need a dramatic rally to signal danger. It only needs to remain calm while real-world pressures build. At Sayfee Metals Health, the goal isn't to predict prices or spread fear. It's to help you understand how systems behave. And one of the most misunderstood signals in finance is stability. Stability is comforting, but stability is not always healthy. If you've watched this far, I want to hear from you. Do you think calm silver prices mean the system is working? Or do you believe they hide deeper risks? Drop your thoughts in the comments. Your perspective helps others think more clearly. And if this video gave you a new way to look at silver in the financial system, share it with someone who still believes calm markets are always safe. Sometimes the quietest signals carry the biggest warnings. Thanks for watching, and I'll see you in the next video on Sayfee Metals Health. Why this script is strong.